Morning, everybody. Welcome back to the Opportunistic Trader. It is 11 a.m. and now we're joined by Brynne Kelly, the Fundamental Angle, and Mike Korn. They've been joining us recently to talk energy, all things energy, starting out talking about natural gas. They just had their figures recently. Brynne, Mike, I'll let you guys take it from here.
Thanks, Mike. Good to be back. And Mike, the other Mike, so many Mikes. Good morning.
Good morning, everybody.
So I thought I'll go through the numbers real quick since those just came out, and then Mike and I have just some interesting things we're noticing about some of the structure of the nat gas market, and then I'm going to pick his brain a little bit, I think, first on oil. So getting right into the numbers, the market was expecting around 50, and we ended up, I don't know why my thing shows negative there. Anyway, I don't even know what, ignore that slide. Anyway, we put in 48. And of course, we're still behind. It's the same story every week, although that's really disturbing to me that fed in wrong. So I suppose that would probably make a lot of these a little bit different. But in general, the theme is that we're most short in the Midwest and in the South Central. Although, interestingly, if you think about this summer and weekly average injections, so far we've had 29 weeks that have gone by out of the 30 for the official season. I know I talk about that every week, but we're counting it down. We've got 1 week left of the official season for when the end of storage futures expire, the ICE contract. So we've put in an average of around 59 a week, which isn't really that startling in and of itself. It matches the average weekly injections we've had for the last couple of years. However, given the talk about production and the continued output and growth in output, it is a little bit startling that we haven't managed to surpass prior years, which to me, and I think it'd be reasonable to deduce that obviously demand is certainly keeping pace with production growth. And that demand really is stemming from, at least this summer, exports, and whether that's exports to Mexico or LNG exports, and to some extent a reduction in imports from Canada. So all of those things added up have really left us injecting this summer relatively similar numbers to the prior few years. It's just that we started at such a lower level. If you take a look at South Central inventories, the purple right here is the non-salt, and red is, purple is salt, red is non-salt. And combined, we have not been at this level for this time period in the storage season since 2014. So interesting in that injections have, our inventory levels are sitting, at concerning levels that, depending on the weather, that we have, and we all know what happened in 2014. So we're vulnerable. We have been vulnerable. Overall, injections by region, you can see they've matched the last 3 years, but prior to that, we had been averaging around 90 BCF a week. So same picture, same story, and everybody is watching the market and wondering, what does that equal from a flat price standpoint? And that's where I wanted to talk to Mike today, because it seems as though really this winter, the positioning that people have been looking at is much more in spreads versus options. I found it interesting yesterday, and I even kind of saw the same thing in oil, just on the other side. But as they were bidding up the front of the nat gas market, there wasn't the rush to buy upside options as there usually is when we're at this point, time in the year when we have all of the catalysts that could lead you to believe there's some explosive upside at some point. And instead of trying to pick your exact point to get into futures, people just reach and they buy these options. But maybe they're tired of paying 50% vol or 45% vol, and the daily moves aren't enough to even help you recover any of that premium. So along those lines, Mike and I were talking about some of the spreads between the different winter contracts. And before I show some of those charts, Mike, I know you've taken a look at this before, but I think it's a good idea to get an idea of what the structure of the market looks like, whether it's LNG or some of the basis locations. And so here are the futures curves. And the most interesting is the February to March spreads, whether it's LNG or some of the East Coast basis locations, and even in the Midwest and out in California. There's quite a drop off between Feb and March, much more than there is between March and April. And I only bring that up because I want to sort of talk about how the Feb March has performed versus the March April. And I know, Mike, you and I earlier this summer were talking about the blowout in Feb March at the beginning of this year, and how maybe you could draw on some of the fundamental pricing structure that we see in some of the demand centers like Boston and out in New York and New Jersey and even California, right? Some of the real demand centers, and how it certainly prices in a much more significant heating demand in February than in March. And it's not to say that March can't end up, being an extremely cold month, but for the most part, from a total heating degree days as a month, it just can't compare to February typically, because the back half of the month we end up losing so much as we kind of start heading into spring. So keeping that previous picture in mind, what I wanted to take a look at is first let's look at that Feb-March spread. And the reason I'm focusing on this is historically, prior to actually heading into the December and the real cold weather, people start positioning themselves or reflecting their bull-bear sentiment through the March-April spread. And you would see that on Thursdays after the number comes out. If it was bullish, people just run and grab March-April. The actual spread level itself tends to be irrelevant, since we know at expiration it has tended to come down to flat. But prior to that, the market has, you could always kind of interpret the market's bullish sentiment through the March-April spread. And it's just been much different this year. And I think it's a good idea to put on your radar screen instead the Feb-March spread, how that's performing, and if that's really giving you a better look at the bull-bear sentiment. Is that making sense, Mike?
Yeah, definitely.
So first, I just went back and looked at what has the Feb-March spread done in the last, 6-7 years. And I think it's always so funny because the market tends to try to think or it remembers history as it tries to price the spreads for the next season. And coming into, prior to the big polar vortex of 2014, usually, and I remember this, and I still have a lot of this bias in me, March outperformed February. And you can kind of see that in how these spreads expired when the Feb contract rolled off, that Feb settled below the March contract. And then all of a sudden, we wander into 2014, and things were much different, and people ran to the front of the market when we had the weather event because they needed it, and they ran to grab January and February. And as a result, that spread flipped, and we had Feb go off the board stronger than March. And then we sat around for the next 3 years with way more inventory in the ground, and much, much milder weather. But people had 2014 in their mind, and still kept giving premium to each prompt contract as it was coming up. So as Feb was rolling off, they were much more interested in owning that versus March, just because of the history that we had experienced. And then all of a sudden we had this year, and it was a massive blowout. And I think if you remember, it wasn't a warm winter. It was just sort of a concentrated cold spell that we had right around the end of January or mid-January. And we saw cash prices spike. And, I hadn't really, thought as we went through this summer in the doldrums, I hadn't been thinking about winter positioning, and I hadn't gone back and taken a look, but it's so interesting when you see it right in front of you. So the Feb-March suddenly blew out 40 plus cents. Feb settled over March. And we all know how March until now went on to trade, right? Or until at least the beginning of October, just 280 plus or minus all summer long. And so now we have the 2019 spread. And with history in our mind, with the structure of this curve, clearly in most basis locations, you have the widest spread being between Feb and March versus March and April. And so people are placing their bets using that spread. And I think it's a good idea to start thinking about how you can get some positioning on that tracks that versus just having to outright decide that, this morning, I think the spread almost hit 25 cents over. And after the number, I think we went down a penny versus the March-April spread, which again, 2012, 2013, we had March settling under April. And then bam, 2014, the spread blew out. And of course, the March-April has notoriety to it. It has history with Brian Hunter and Amaranth and the spread blowing out. And so everybody, it's a vulnerable spread. And it's kind of a place where people have traditionally run in hopes that something like that will pan out again. And there's actually a lot of CSOs, the calendar spread options that people trade around before, we sort of get into the meat of the winter. Tons of people buy the flat put, right? Hoping that March settles under. They sell the upside calls. I think it's lost a lot of its luster. But for 2014, we went back, and even in 2018 with that huge blowout in March still ended up settling under April. And yet here we kind of have 2019 sitting more on the low medium end of where you'd think we would be given our inventory levels. and the proclivity for getting into that spread. And the reason I kind of keep going back to 2014, I wanted to go to this slide for a second. At the start, at the end of the winter season in 2014, we had 835 in the ground, versus the end of the winter season this year, we had around 1.3 TCF. Yet by the end of summer in 2014, we had almost 3.6 as an inventory balance. And this year we're sitting around, projected after next week's number, to be around 3,200. We probably could inject and will inject. I think the first week of November is looking at an injection of 46. At least that's forecast right now. But for all intents and purposes, let's just call it 3.2. So we're at a lower start of season balance, and yet we've seen both of these spreads, March, April, to a lesser extent, the Feb March in 2014 blow out. So what I did is I took a look at sort of the relative performance of the two, looking at last year and then this year. I should have put 2014 on there, but it's not as, the spreads were actually, the difference between the two wasn't as significant, which is surprising. So you can see last year, Feb, March, they'd kind of been tracking together with each other. March, April really outperforming, starts selling off, and then bam, all of a sudden they flipped. And almost 60-cent difference between the expiration of the two spreads. And now here we are this year. And I think Feb, March is 24, 25 cents, and March, April is around 28. And are we in this point where we could see the same flip, but earlier? Because, everybody likes to look at history and be smarter and get ahead of it. So along those lines, Mike, first of all, I want to hear your thoughts on that. Just overall, kind of what, if it's having the same impact on you.
Yeah. Could you keep this chart up right there? That you sent me this comparison of Feb, March versus March, April early this morning. And I've been fixated on this one chart to the exclusion of looking at a lot of things. I'm just really fascinated that Feb, March has rallied, has widened out, which, okay, you can make an argument for that being the case. But I would have thought March, April, if anything, would have in tandem, not necessarily keep up with it, but would have a little bit of life on a rally, or at least stay flat. But it's actually gone the opposite way. And I don't know why there's that inverse relationship here. And, or is it now becoming quite clear that March is a dog? I'm just not sure about why this is the case from a fundamental point of view, even from a technical point of view. And if you go back to the chart you had before, nope, that one right there. When we discussed this earlier in preparation for this program, we were pinpointing when did it cross over, and it looks like the middle of last year. And but it's very interesting that the two spreads are trending in opposite directions, and that signals that, or I shouldn't say signals, but that this means to me that there is a play here. I'm just I do.
I love it from the standpoint that finally there are some glaring things standing out, and I can certainly make the story for, fundamentally March and April, that there shouldn't be that much of a premium on March. If you just want to think about fundamentally how the system operates, most storage contracts run November to March or April to October. So towards the end of March, you have to get, as your storage contract is running out, you need to draw down and kind of close out that season. And traditionally, storage is, one direction. It flows out in the winter and it flows in the summer. So you picture a warmer end of March with a higher inventory balance as we've had the last few years and growing supply. It gets a little bit ugly towards the end of March because you're pulling gas out of the ground and selling it into a market that doesn't necessarily need it. Versus you flip the switch in April and all of a sudden you've signed your new contract and operationally you can move gas into the ground. I know, and this is obviously a general statement. I know each individual storage unit is different. And of course, we have withdrawn gas at the beginning of April, just like we will inject gas at probably the first few weeks of November. But overall, you're really looking at two different seasons, and you're looking at pulling gas out and selling it into a market that perhaps doesn't have enough demand to support it at the end of March, regardless of what levels are. You're drawing it out, and then looking at the start of April, where you're planning now for your storage injections for the year. And so you may be buying because it's a little cooler at the beginning of April, like it was, this last year, but you're also buying for storage. So the dynamics change so significantly, which is why I always found it interesting that spread in the first place ever kind of became the wild card. Versus February and March, you're still within the season, operationally, you're still running things the same. You're still withdrawing from storage. And it's reasonable to expect weather to be colder in February than March, to have a greater heating degree day average for that month. And it seems like, the market is really waking up to that. Add on top of it that this year, this market has been one that only wants to buy the front. And we saw that with the November expiration. It expired, I want to say flat to just a little bit over December. And at the time, I think earlier this week, the December-January spread was around 7 cents. And last I looked this morning, it was below 4. So that spread is on track here now. Are we just going to continue to see the front month because it's the cheapest seat, right? To be the thing that is bought more than, it preserves withdrawals from storage. And if storage levels are low, you will preserve your withdrawals as long as you can. So it doesn't mean that we might not run into a problem in March. But so all that being said, Mike had some, as he always does this morning, he was kind of pushing me on that. Well, how do we look at that in the options markets? And if you look at implied volatility in February, I think it was around, 46%, Mike, 47% this morning?
A little higher. Hang on a second. Feb. Actually, an option with a 30% delta is right at 50% to 51%. That's the 375 call in Feb.
Yeah. So, and I think the at the money is around 46 or 47, or it was this morning. Whereas in March, I think the at the money is around 43 or 44. So, 3% difference in implied volatility between those 2 months. Yet March versus April implied vol is almost a 25-point spread. You go from 43% in March to around, or 25 or 20 something. So 20 vol difference. And if you translate that into the spreads, you can see, all right, well, a 30 cent, 28 cent March, April versus the implied vol difference, you can get your mind around that a little bit, because obviously you'd have a bit more ability to, trade around your delta with a March option implied. But the implied vol difference of 3% versus the Feb March spread of 25 cents, 24 cents, it seems off.
Yeah,
go ahead, Mike.
Yes, I do not have a historical.
Wait, are you there? I think I might have lost. Okay. All right. Well, yeah, I can fill in for him. So in my mind.
Sorry about that, back in.
Oh, you're back.
Yeah. So real quickly, when it comes to if Feb and March is indeed the new March, April, or it's been developing that way for the last year, then I would expect to see some of the same differences in vol between that the money calls the Feb versus March. It's having some of that same vol differences that March, April used to have. I don't know where the difference in vol between March and April was back in the polar vortex. I don't remember that difference, but before then, on natural gas, going back when we first went above $10 and to $14, even before going up to $10 in the early 2000s, the vol difference between March and April. March was about 12% over April, and again, I don't know if Feb March is necessarily like the new, everything moving forward a little bit on the curve. There's a potential for that difference of 3% Feb over March implied vol of looking at calls with 30 deltas. There's a good chance that can go at least to 10, 11, 12%. It's not,
for sure, because of course we live in the Northeast, but if you think about the southern regions and California, there really can be a dramatic difference between February weather and March.
Yeah.
It's not as dramatic necessarily always on the East Coast and in some of the Midwest, but really by March, you can, and even the end of March, you can almost start looking at some air conditioning load down in some of the South, or at least at no load, like perfect March ends up being one of the more perfect weather months. I remember when I lived in Houston, it was, like the only month you really got some respite, because it already starts getting hot in April, like really hot. So, and if we're looking at Henry Hub, which, as much as people want winter prices and cash prices to clear at Henry Hub and blow out in the winter, that's generally left for the East and the mid-continent markets, and hence the futures curves price themselves that way. So I can see as the markets evolved that it really is, you can make a huge case for February. I don't want to leave January out. The
right.
Jan Feb spread is like 9 cents January over. And look, I'd be even inclined to sell that and look for Feb to go over in that case. But going back to this spread, so we were talking about options, and the thing is, who's to say, is there a target for Feb March? Is it going to blow out to 40 cents? Is it going to end up, is weather going to be a bust? Is it going to flip back under? Outright levels, I mean, we had the polar vortex and the spread, maybe got out to 20 cents, and outright prices were much higher. So this is really not a call on outright prices, but the way that the market has been reacting, especially with inventory levels where they're at, it wants the immediate molecules. And so it runs to the front of the market. And to give yourself the ability to trade around that spread, and especially if it, on any day when it blows out, being able to sell it with a little bit of protection, Mike and I were looking at some, I guess, calendar spread options, but you would have to leg it. And we looked at two different, I guess, two different strike comparisons. One would be buy the 350 call in Feb and sell a 375 call in March. And, I think just before I came on here, that difference it was a little over 10 cents this morning, and it was down to 9 or a little bit under after the number came out. So pay 9 cents, right, to actually have a calendar spread option with 25 cents the other way on the spread.
I do want to point out that, so it wouldn't be a calendar spread option in that it wouldn't be an option on the price differential.
Right, you have to leg.
But it would be two separate calls. So you'd be, buying the Feb 350 and selling the March 375 calls. Yeah.
Exactly. Great. I'm glad you pointed that out. Right. It's legging into a spread using options. And I think that gives you a nice thing to trade around as the market, because we still we don't even have weather yet.
Yeah.
And the reason, we're gapping kind of the front up and down 10 cents here now, before this, we were lucky if we could move a couple pennies in a day, is everybody's kind of getting their positions on in anticipation. And then, the reality is that right now we don't have anything crazy that is, we only have sentiment. We have cash that's finally, printing 320, 325 every day at the hub. But we don't have the basis locations like the Northeast. You look at this chart, December for, at Algonquin is 775 if you want to take Henry Hub plus the basis. And you really need that cold weather to show up, to clear there. It's in the same thing for really Dec, Jan, and Feb. You're committing, and is the market, as December rolls off the board, are people going to go long, this $8 product if cash is still clearing 350? I think even like in Dominion and some of those areas were back below $3. And it just makes it hard to get things moving without, you're on sentiment alone. Hence, everybody is running into these spreads as kind of a way to make sure they have some exposure on the books when something is going to move, regardless of what the flat price is doing. I know right after the number came out, the market started to sell off, and I took a look at Dec Jan, and it was still, just under 4 cents. So those spreads are not reacting when flat price comes off to the extent that flat price is coming off. And yet when the front is moving higher, people are rushing into those with, kind of reckless abandon. And we've seen that. The other two strikes we looked at was 350 call versus 325 call. And in that, you're getting a bit of a credit, maybe a penny, just about, I think, at the last time I checked.
Yeah, you're talking about the 350, which is theoretically at 1880, so just under 19 cents. And the March 325, there's a little bit of a credit. That's at 19.5 cents, theoretically.
Yeah, I don't know why for some reason, I don't like that one as much. I suppose it's because I am bullish. I'm bullish, a situational, spike, and I don't want to be caught. But either way, why I am going to put this position on is that now I have a reason to trade around this Feb March, and I have some protection if I get cute and all of a sudden the spread just completely blows out.
And one more reason to add to that we touched upon is the difference in vol. If you go look at the Feb March versus Feb April, if you just look at the Feb March, you look at how that has spiked. Yeah, it could continue to accelerate in that kind of level, kind of way. One would think, just looking at the chart where we are right now, that Feb vol implied by that of the money call would be a lot higher than 3% over the March, when the March-April has always had a much bigger gap, March always being much higher vol, which now is the case, right? We saw March implied vol over April implied vol like at 25% higher. So that's another reason why I like the option trades, just for the vol implied by those calls.
Absolutely. I think
which could be, I just says it's possible that what this is, it's possible looking at that 3% implied vol difference Feb over March. It could be that could be signaling that Feb call options are as much premium as they're in right now, that they could actually pick up premium just on an increase in vol of a couple of percent.
Well, yeah, I was gonna say that as I mean, who wouldn't want a market with 50% vol in it? Thanks, Mike. Wow, that always goes by so fast. So yeah, as high as that seems, something is mispriced between the two of those, and we've taken sort of the long way around. But bottom line, if you're looking for something other than just trading flat price, but you're looking for signals of the bull bear sentiment of the market, I think it's a good idea to keep the Feb March spread up on your screen. The only other thing, just as a complete aside, Mike, I wanted to just ask you a quick question about oil.
Yeah.
We saw Cal 19 a couple weeks ago. It was bid above $70, and I would have thought that would have waved in a bunch of producer selling. And now what are we down at, 66?
Yeah. Oh, by the way, at the beginning of October, that first week, from my desk, I did see some action by producers selling hedges, selling, futures and options, buying fences, buying put, selling call, selling swaps, the Cal average. That was only in the first week. After that, for me, it dried up pretty much.
But that was above $70, right?
Above 70, yeah. And just a few minutes ago, I just looked at Cal 1965. 35 bid. I'm looking at the contango of crude, and now the top month, highest price month, I believe was July now. Hang on, or June. July is the highest price month of crude right now. But what I'm particularly looking at as a sign that we could see more action from my client base, namely producers and banks, would be if the difference between Cal 19 at 66.35 drops in relation to first half 20, which is 64.08. So in other words, there's $1.27 premium for Cal 19 over first half 20. That's been coming in, and that's what I'm focused on, even more than the contango of the first 6-7 months. For me, the only
reason I wanted to bring that up really quickly is, we've lost, $7 in the back of the curve, which is typically what you look at when you're looking at some of these, big energy equity stocks.
Yeah.
It's one of the reasons why we were unable to get them to rally in the first place, even though the front of the market was rallying and we were in such backwardation. All of a sudden now we've, taken in a short fashion, taken $7+ out of the back of the curve. And I think that's going to put a little kink in a lot of people who've been really jumping on the get bullish energy equity bandwagon. All of a sudden value has changed significantly. So on that note, I know we're running late, so please, if anyone has any questions, feel free to put them in the chat, and we'll be back again next week. Good to talk to you, Mike.
Thank you. Great talking to you. Thanks for the extra time. Crude making new lows here.